Awesome. So here's what we're looking at. Looking at Crandall, Texas. Might as well be Dallas, right? Dallas, you're looking at a property, brand new built property right now. It's got a $277,000 value, but for a limited few of them, they will let you jump in there at $234,984. Now, that's an interesting number that came up, but it was based on a percentage. Now, if you're coming this at 25% down, this is what they're presenting. A 25% down deal, that means you're going to come in with a down payment of $58,746, which gets you a loan amount of $176,238. Now, the other people that are buying out there, which is not you, because if you come through this source I'll connect you with, they would pay retail $277,000. That $277,000 putting 25% down is $69,250. That's a $10,500 plus for you. That's that swing that is in the green. If you look way over here, swing in the green right now, $10,504 in your benefit. Now, what does that do for you? You've got a lower loan size, $176,238 versus $207,000. That's a benefit because you're putting less out of your pocket. Less invested means higher return. Well, if you take the loan amount and you have your tenants paying it off, which is what the goal is, have the tenant paying off the loan, keeping something reasonably rented the entire time you own it, what are they giving you? Well, they're paying off $176,238 over 30 years. And I caution you, don't get caught up in doing that crap. You try and pay it off early. Just pay the damn loan, keep your cash flow, use that to be able to deal with vacancies and other things. Don't pay down your mortgage. So that means they're going to give you, amortized over 30 years, $5,875 per year, averaged over 30 years to pay down that loan. Well, you divide that into your down payment plus cost, your down payment of $58,000 plus, let's say, $7,300 cost, you're all in at $66,055. That's an 8.89% return on investment. Not bad, because you're putting 25% down. That's why, putting 20% down, you're going to see it crack double digits. But we're going to say this 25% down, because that's what they're presenting. Now, let's say your property appreciates only 2% per year. That's it, 2% per year. What is 2% of that $277,000? That's $5,540 per year. That's equivalent to another 8.39% on your invested capital of $6,600. Then let's say you got we got our principal and interest at today's rates. You can use your $10,000 to buy down the rate too, because you're saving 10 grand. But let's just talk about it as it's going apples to apples. So you're going to end up with $1,157 in principal and interest, $114 or $114 in monthly insurance, $700 in taxes, guys. This is Texas. So you switch that E and that A around, you can spell Texas with taxes, and it's evident right there, $706, right? So now you're at $1,978 principal, interest, taxes, and insurance. Gross rents are $2,200. That's why the gross rents are so high on this, because it's Texas, right? So now look at your monthly capital that goes into your contingency account, $296. That's a 5.38% growth on what you invested in the property. So you add it all together, you're 22.66%. Now, let's look at the average retail person's doing. $277,000 price, 25% down for them to $69,000. All in there, $76,000. Again, $10,504 more than you. Well, you look at their amortization. Well, they're amortizing a bigger amount, right? So that's $6,295, which is equivalent to 9.05%. Because you guys' costs are exactly the same, even though your amount is lower in your actual down payment. But higher amortization means you're at 9.05%, so it's a 0.15% different than you. Not a big damn deal, right? Appreciation, same 2%. That's 7.24 based upon what they invested. That's a 1.15% improvement that you have. So really, you're up 1% on them in total revenue, and you're $10,000 less in total cost. Not bad. So then you look at the principal, interest, taxes, and insurance. You've got your total gross rents are the same. Principal interest is higher. So they're only making $89 a month. You're at $296. They're at $89. There's another big move there. So that's 1.4%. I mean, that's a 3.98% difference. Their total revenue, 17.68%. When you look at those numbers versus your 22. Not a bad situation. Having a hard time, but that's one of the ways you can do it now, because that's what we're talking about. Have a great weekend.